David, we heard it from Jay Powell himself, and no doubt he'll say the same again today. Too early to pull back on monetary stimulus. Let's translate what that means for investors, for financial markets, as someone who speaks for $1.5 trillion. David, is now still a good time to be taking risk, or is now a time to get cautious?
Well, first, a few comments on the chairman's remarks yesterday, and I do think he'll say exactly the same thing today. Without any doubt, the place to look is the labor market. There is all this noise about the monthly CPI indices that come out. I would encourage your viewers not to spend a lot of time on that. All of the action is around the labor market. And that's what you need to do to understand the direction of the Fed and to understand inflation. So in the direction of the Fed, what's very clear, and they've been very consistent on this, is that until we have a lot more job creation in this country and we see unemployment going back down, they are not going to move on rates. So watching that growth of jobs is the most important place to focus. And then secondly is how the actual employment marketplace works. It's too early to tell. But it will be very interesting to see whether or not we do get a rise in wages because it's hard to lure workers back, or will we see that actually employers have made significant advancements, they don't need as many workers, and actually the rise of automation is going to keep wages down. Both of those, I think, are plausible at this point, but we're watching very carefully to see which one. Because what we do know is that if we're going to go back to higher long-term inflation, those wages will need to rise. We've never seen it happen without that. Our view at the moment is that the inflation levels are transitory. We agree with the Fed, and we think their stance is very appropriate given the stage of the economic recovery.
David, the debate over the timing of a taper is intensifying inside the central bank. St. Louis Fed President Jim Bullard told Mike McKee right here this morning, it's time to end these emergency measures. How soon do you think the Fed should slow its bond purchases from $120 billion a month?
So that goes back to what I'm watching closely. That will depend very much, I think, on the employment picture and how quickly that picks up. If we have very strong job numbers and we begin to see wages beginning to rise, then I think we could easily enter into talks starting in Jackson Hole, and then actually the fourth quarter here beginning to be some kind of tapering. If, however, those employment numbers are much weaker than I've just projected, then I think we're looking at 2022 before that begins to happen. But I think that labor picture is the piece to focus on to really understand where they're going to come out.
David, when you look at the S&P 500 up almost 17% year to date as a proxy for risk assets, and the Shiller PE ratio pushing higher and higher, now at 38 times. What signal are those indicators, let's call them, sending to the asset allocators who are your clients?
So the dominant fact of the investment landscape today is that it's never been more punitive to hold cash, full stop. For the last 24 months, that's been true, certainly in the United States, but even more true actually around the world. And what that's doing is driving unprecedented amounts of money out of government bonds and into higher risk assets. Certainly including equities, but also including a wide range of other alternative assets, where we see the search for yield just intensify. So I think what you have to believe about valuations today is that those are supported by a view that rates are going to stay low for longer. That's a view that we certainly have, but others have been pushing back hard against that, and time will tell.
Well, let me go back to my first question then. You speak for $1.5 trillion. Is it time to be taking risk or time to get cautious? It sounds to me like you're on the risk-taking side.
Full stop. We believe that risk assets are attractive today, and we certainly are constructive on risks. We're mindful of some places where pricing has run ahead, but broadly, there's plenty of risks in the economy. But our base case is for the next 18 months to have very strong economic recovery and economic performance right across the developed world, and including China.
David, you and I have talked many times about the need for consolidation in asset management. Earlier this week, PGIM announced a small purchase, a Swiss private equity secondaries firm called Montana Capital. Is that the extent of the deal making we'll see from you, small bolt-ons?
So let me put this a little bit in perspective in our terms of our broader alternative strategy here. So we manage about $250 billion in alternatives across both public and private. We're the third largest alternatives firm in the world. Mostly for us, that's been a very leading real estate business and a private credit business. But we've been seeing a lot of money going into alternatives over the last 4 or 5 years, and we've been working closely with our clients on their alternative strategies. One thing that's become very clear from their perspective is that they feel that they need more liquidity for their private equity portfolios, and increasingly now for real estate and private credit. And what secondaries do is allow them to actually swap out their LP interests. Mm-hmm. So this is bringing liquidity to the private equity industry. And that is, we see a very kind of early stages, but rapid demand in that. And so we are delighted to welcome Montana Capital Partners to the PGIM family. It's a very high-class firm that's been around for a decade and has a terrific investment capability. And we believe that they're going to be really critical to meeting the needs our clients have for finding more ways to provide liquidity into their private equity portfolios.
David, why just secondaries? Right? The money is pouring into buyouts. Look at Hellman and Friedman. They raised $24 billion for a single fund. That's news out today. Why isn't PGIM participating in primary private equity?
So, Eric, we certainly have spent time looking at that, but in truth, we don't see what we bring that is special to that particular area. The world does not need another KKR. What we think we bring is a unique investment capability and an institutionalized capability in secondaries, now with Montana, where we can actually build a fundamentally differentiated franchise. So I applaud the leaders in private equity. I think that they've done a wonderful job. And as you and I've talked about before, I think that's going to continue to grow. But for us, we wanted to have a distinctive capability where we could actually build an institutionalized investment process that would directly speak to what our clients need today.
David, one last quick question for you. I can't help but notice the enormous ESG business you're building inside PGIM. It comes with some risks, I might say. How big a problem, David, is greenwashing in sustainable investing?
I think, Eric, it's a major problem. There is so much kind of marketing spin around ESG now that sometimes it's hard to separate the wheat from the chaff. And I think that the big question that I would encourage all of your viewers to ask their asset managers is, to what extent is ESG fundamentally grounded in your investment process? So it can't be a screen. It can't be a separate overlay. It needs to be part of how you manage money on a day-to-day basis. So every bond that we own has an ESG rating on it. Every stock we own in our quant portfolios has an ESG rating. And we use that both to make sure we're fulfilling our fiduciary duty to clients and considering those risks, and to then offer products that allow our clients to express how they want to invest in ESG. But if you don't start with that foundation of a true integration into your investment process, then you're really just on a marketing campaign. And that's the thing to look for.